Where's the next crisis?
The next crisis will probably be as regards to what China's doing and their intention towards Taiwan. I think that's what we're going to have to focus on going forward. Given the statements recently made by Xi Jinping, I think, and the fact that Biden has said that the U.S. government will support Taiwan, I think that will be the next crisis coming up.
What do you make of what we're hearing out of the Party Congress thus far? I have to say, Xi Jinping sounded like he is determined to maybe sacrifice growth for that geopolitical stability that you've just been talking about vis-a-vis Taiwan. As investors think about Taiwan, as they think about the Chinese economy, is that the trade that we should be thinking about? A slower Chinese economy, but a more potentially belligerent China with reference to the rest of the world?
It's not only about a slowing Chinese economy, but the safety of investments in China, because you've got a situation where, for example, just now the U.S. has said any Americans working for Chinese tech companies have to quit or lose their citizenship. That's an amazing statement and has tremendous implications for the development of Chinese technology. So that is a big problem facing China. And then, of course, in addition to that, the lockdowns and all the rest of it is going to present big challenges for China. And of course, unfortunately, when the people are against the wall, they fight back. And that's probably what we're seeing with the statements made by Xi Jinping. He's saying, he's making belligerent statements.
When it comes to Taiwan then and chips, for example, and the growing conflict between the U.S. and China, how do you price for that as an investor?
Well, what we do is we say, okay, let's look at those software companies that do design for chips, that don't have fabs, what we call fabless companies, and companies that have a leg in America. I mean, you look at any Taiwan tech company, they have an office in Silicon Valley, or they have offices in other parts of the U.S. So that's the kind of companies we want to be in case something happens. Unlikely to happen in the near future, because you must remember, if the U.S. puts trade sanctions on China to any greater degree, this could be a big problem for Chinese economy. So any case, that's the way we are handling that situation.
When you think about what's happening in emerging markets more broadly, we have fragmentation of the global economy. It's going to be interesting to see just how far that fragmentation goes. Ultimately, are we going to see two spheres of influence, Mark? Is that how I should be thinking about the countries that I want to select to put investments in? Is this the way we're going? Is it going to be a Russia-China sphere of influence and a rest of the world sphere of influence? How should I be categorizing geographically where I want to put money to work?
I think you've got to consider the Indian sphere of influence, because India is coming up and is benefiting from the problems that China is now facing. So a lot of the manufacturing that's now in China will be moving to India. And of course, you've got tremendous advantages in India with an English-speaking population. And you already have a huge software industry. So I think India is a place to be. And a lot of the manufacturing that's now in Southeast Asia and growing in Southeast Asia, Vietnam, Thailand, Malaysia, Indonesia, will be gravitating more and more to India. So that's a very exciting prospect, I believe, going forward.
Mark, do you need a certain dollar in order to really execute on that thesis?
Well, when you talk about dollar investments, you have to be very careful, of course, with some of these emerging market currencies. But what we're finding is that there are many of these emerging market companies in countries with weak currencies and with high inflation who are benefiting from this situation. Why? Because what they're doing is producing products and software in US dollars, selling them in US dollars, exporting them, and their costs are in local currency because the local currency costs are going down with inflation and with deterioration of the exchange rate. So recently we were in Turkey, for example. We found that to be the case. One car manufacturer said, I can't get enough cars because there's so many people that want to buy these cars. And we're exporting, of course, to Europe and so forth. So you have to look at each individual company to determine where you want to be. But of course, on a macro area, you've got to be very careful that the currency reserves are enough so you can get your money out. So that's what we look at. What are the currency reserves and what are the restrictions on the flows of capital in and out of the country?
Mark, how carefully are you watching the dynamic between Riyadh and Washington right now? We've obviously seen the President of the United States expressing his displeasure about the recent decision by OPEC Plus to cut capacity. There have been some suggestions that we could be seeing an OPEC bill going through. A response to that from Riyadh and other members of the GCC potentially could be maybe to start thinking about repricing their oil exports in something other than dollars, potentially also selling treasuries. How big a tail risk do you think this could potentially be?
Well, I don't think it's going to be very serious, simply because the connection between Saudi Arabia and the U.S. is very wide and very deep. You must remember there are many, many Americans living and working in Saudi Arabia to begin with. And also, there are many other aspects beside oil. If you look at the defense sales from the U.S., one of the reasons why Trump, the first thing he did when he was president was fly to Riyadh in order to sell more U.S. military equipment. So I don't think this is going to go very far. I think, of course, the current administration is very angry, but I don't think it'll go further than that.
Mark, that kind of brings me tangentially to the topic of commodities. We were talking earlier in the show about one of the risks and the idea that the long commodity trade is at risk because there's just so much money in that trade. How would you be playing that right now?
I'd be careful with commodities because demand, in view of the inflation and higher prices, the demand, and must remember, the people that are buying commodities are sitting on weaker and weaker currencies, the emerging market companies, and by the way, the euro is in bad shape. So as a result of that, they're going to be trying to reduce their purchases of commodities. So you're probably going to see a downturn in commodity prices, but it won't go too far, simply because inflation has eaten into the cost of production and so forth, and it'll be more difficult to have very, very cheap commodities. I don't think that'll happen.
Mark, where are you putting money to work right now?
Right now, India, Taiwan, Brazil. We have some things in Brazil, a little bit in Turkey, and also Vietnam. So we're pretty well spread out globally. But of course, the biggest parts are in Asia.
What would you be selling right now?
I'd be selling any companies with a high debt to debt equity ratio, number one. Companies that have a low return on capital. These are the two parameters that are very, very crucial in this day and age because of this problem with currencies and high inflation. Anybody sitting on debts, high debts, are going to be in trouble because of the higher interest rates. I see interest rates in America going to 9% because the Fed is going to have to keep on raising rates. 9.
Mark,
simply
9?
because
okay.
Simply because if inflation is 8%, the playbook says you've got to raise rates higher than inflation, which means 9%. Of course, that theory will go out the window if CPI goes down, but I don't see that happening anytime soon.